studying your last two. I swim med tea when they turned in. The staring down to mute. And can lend a pole that sunk he died.
When a corporation sells one of its capital assets, such as a truck, machine, computer, or piece of equipment, the transaction often creates one of the most important Schedule 1 adjustments. At first glance, selling an asset seems straightforward. The company sells the asset, receives cash, and records either a gain or a loss in its accounting records. However, this is where accounting and tax begin to follow different paths. Let's use the example of a delivery truck. The corporation purchased the truck several years ago and has been using it in the business. Eventually, the company decides to sell it and receives cash from the buyer. For accounting purposes, the accountant compares the truck's selling price with its book value, which is based on accounting depreciation. This produces either a book gain or a book loss that appears in the financial statements. But the CRA does not use the accounting book value. Instead, the tax system uses the Capital Cost Allowance, or CCA, rules to determine the tax result. Under these rules, the sale may result in a capital gain, a recapture of CCA, a terminal loss, or sometimes a combination of these tax adjustments. Because accounting depreciation and tax depreciation are calculated differently, the accounting result is often different from the tax result. This is exactly why Schedule 1 adjustments are required. Schedule 1 acts as the bridge between the accounting records and the tax rules. It removes the accounting treatment where necessary and replaces it with the correct tax treatment required under the Income Tax Act. At this stage, you don't need to worry about calculating recapture, terminal losses, or capital cost allowance. Those topics will be covered in detail later when we study Schedule 8. For now, the most important concept to remember is this: whenever a capital asset is sold, never assume that the accounting gain or loss is automatically the taxable gain or loss. Always compare the accounting result with the tax result, and if there is a difference, that difference is adjusted on Schedule 1. Understanding this simple principle will make the more advanced asset disposal rules much easier to learn later in the course. One of the biggest reasons Schedule 1 adjustments are required is that accounting and tax do not measure the value of assets in the same way. Let's continue with our delivery truck example. Suppose the corporation purchased a truck for $50,000. Over the years, the company records depreciation in its accounting records. This depreciation follows accounting standards and reduces the truck's book value. By the time the truck is sold, its accounting book value might be $20,000. If the corporation sells the truck for $30,000, the accounting records report a book gain of $10,000. From an accounting perspective, the calculation is complete. However, the tax system does not use accounting depreciation. Instead, the CRA uses a completely different system called Capital Cost Allowance, or CCA. Under this system, the truck belongs to a CCA class, and its remaining tax value, known as the undepreciated capital cost, or UCC, may be different from the accounting book value. For example, while the accounting records show a book value of $20,000, the tax records might show a UCC of only $15,000. Even though it's the exact same truck sold for the exact same selling price, the tax calculation may produce a completely different result. Instead of simply reporting a book gain, the tax system may create a recapture of CCA, a capital gain, a terminal loss, or in some cases a combination of these outcomes. This difference exists because accounting depreciation and capital cost allowance are calculated under different rules and for different purposes. Accounting depreciation is designed to fairly allocate the cost of an asset over its useful life for financial reporting. Capital Cost Allowance, on the other hand, follows the specific rules of the Income Tax Act and is designed for calculating taxable income. A common mistake made by beginners is assuming that the gain reported in the financial statements is automatically the taxable gain. In practice, that is rarely the case. The key point to remember is simple. Accounting uses depreciation. Tax uses capital cost allowance. Because these two systems are different, selling the same asset often produces different results for accounting and tax purposes. Those differences are exactly what Schedule 1 is designed to reconcile, while the detailed tax calculations themselves are handled through the CC rules that we'll study later in Schedule A. When preparing a corporate tax return, the sale of a capital asset should never be reviewed in isolation. A systematic review helps ensure that the accounting records and the tax calculations are both considered before completing Schedule 1. The process begins by identifying the asset that was sold. This could be a delivery truck, machinery, office equipment, furniture, or any other depreciable capital asset owned by the corporation. Next, determine the asset's original purchase cost and the amount received when it was sold. These two numbers form the starting point for both the accounting and tax calculations. Then review the corporation's financial statements to determine the accounting result. Did the sale produce a book gain or a book loss? This information comes from the accounting records and reflects the asset's book value after accounting depreciation. However, don't stop there. The next step is to review the tax records, particularly the capital cost allowance information found in Schedule A. Here you'll determine the asset's CC class, the undepreciated capital cost, or UCC, and the amount of CC previously claimed. Once both calculations are available, compare the accounting result with the tax result. The tax calculation may produce a capital gain, a recapture of CCA, a terminal loss, or another tax adjustment that differs from the accounting gain or loss. Only after making this comparison should you determine the appropriate Schedule 1 adjustment. In other words, Schedule 1 is where the accounting result is reconciled with the tax treatment required under the Income Tax Act. To complete this review accurately, you'll usually need several supporting documents. These include the purchase invoice, the bill of sale, the fixed asset register, the depreciation schedule used for accounting, the CC schedule used for tax purposes, and the relevant general ledger entries. As a tax preparer, it's also helpful to ask yourself a few key questions. Which asset was sold? What was the selling price? What was its accounting book value? Which CCA class does it belong to? And finally, how does the tax calculation compare with the accounting result? The most important lesson to remember is this. The accounting gain or loss on an asset disposal is rarely the final tax answer. Always compare the accounting result with the tax calculation before completing Schedule 1. By following this review process every time, you'll avoid common errors and ensure that the corporation's taxable income reflects the correct tax treatment for the disposal of capital assets.